Good morning, or good afternoon or evening, depending on what corner of the world you're joining us from. REF, otherwise known as Renaissance Executive Forums, is pleased to bring you another interesting and informative session in our Expert Insights series. My name is Jim Neidhart, and I am a business partner at REF based in the New York City area of the United States. Today's topic is on navigating the expansion of your business in the US. And we are pleased and honored to have Bill Connolly and Vinay Navani, two of the foremost experts in this area, who will share their expert insights with us. Vinay Navani, a shareholder at prestigious accounting firm Wilkins Gutton Plan, joined the firm in 1998. His client roster includes emerging and established businesses in the high-tech, software, life sciences, pharma industries, as well as other closely held businesses and business owners. He assists his clients on income tax planning and related matters, such as business, sales, and restructuring, retirement plans, charitable giving, strategies, tax audits, and other topics. Vinay devotes much of his practice to international tax matters, including U.S. tax aspects of international business, such as foreign businesses doing work in the U.S., U.S. businesses doing work abroad, transfer pricing, and cross-border mergers and acquisitions. Vinay assists mid-market multinational clients create and implement tax structures to minimize worldwide tax, but at the same time are practical to operate. For foreign-based businesses, Vinay and his team are often the first point of contact to steer clients through the different and difficult hurdles of doing business in the U.S., giving these clients peace of mind and that their businesses are tax compliant in the U.S. Immediately before joining the firm, Vinay served as technical manager for the American Institute of Certified Public Accountants. He's also previously a tax manager at an international CPA firm. Bill Connolly is a partner at Sherman Atlas, a prestigious law firm in the New York City area, who has spent more than 30 years building his expertise in business transactions and corporate law. He focused on domestic companies with annual revenues of 20 to 500 million in revenue and international firms with operations in the US. His clients range from technology startups to international conglomerates. From his offices in New York City, as well as New Jersey, Bill often acts as outside general counsel. He also acts as general counsel for his own law firm. Bill oversees transactions that help companies grow, including acquisitions, mergers, financings, workouts, shareholder disputes, and contract negotiations. He manages teams of legal experts for large corporations with complex problems and often counsel to individual executives. When clients need additional expertise, he draws on his large network of contacts in finance, accounting, and other business services. Since 2011, Bill has been listed in Chambers USA, the most competitive international guide to top lawyers, which praised him for, quote, impressive work involving buyouts and stock placements. He has been named the best lawyer in corporate law by Best Lawyers in America since 2008, and Thomson Reuters has included him among New Jersey's super lawyers for mergers and acquisitions every year since 2007. So with that, I will turn it over to Bill, I believe.
Yes.
So go ahead, Bill, take us away.
Okay, can we get the agenda?
There we go.
So thank you, Jim, for that introduction. Today we're going to cover choosing your entity. So you come to the U.S., which type of entity will you do business in? Startup issues, forming your entity, making your first hires, startup type issues, the tax treatment for your U.S. entity, the tax treatment for executives that you send to the U.S. to work for your U.S. entity, things to think about if you're thinking of selling your U.S. business, and then a list of other situations after you're startup and running and you've hired your employees, when you might consider consulting with your attorney or accountant going forward. So first, I just wanted to say, we know some of you have a very sophisticated understanding of the U.S. system. So we apologize in advance if some of you know some of the information we're presenting. We just want to make sure we make it present in a way that's useful for everybody. So we're going to go high and low. Just as a way of introduction, we want to explain that the U.S. has a federal system, which means that your business in the U.S. is going to be governed by national laws and state laws. For example, if you do business through a U.S. Delaware corporation, the laws of Delaware are going to control how your board of directors meet, how you have a shareholder meeting or vote, how dividends are paid. However, if your Delaware business creates a new technology that you want to patent, you're going to have to make a filing at the national level because IP is governed by national law. The point here is that your advisors and you are going to navigate between national and state laws for all of your legal issues. Just looking at the slide, you can see that on a national basis, immigration is a federal national law, intellectual property, bankruptcy, for more state-based laws, forming your entity, contract law. When you form your entity, you're going to form it in a particular state of the 50 states in the U.S. And then there's significant overlap on taxation, employment law, data protection. They're going to be governed by both federal and state laws. Okay, on to the next slide, please. Okay, selecting your entity. Later in the presentation, Vinay is going to explain why, from a tax perspective, you do not want your business formed in your home jurisdiction to do business directly in the U.S. But in addition to tax reasons, there's other reasons why your home jurisdiction entity does not want to do business directly in the U.S. It probably does not want to be subject to jurisdiction for U.S. courts. It doesn't want to have to comply with U.S. employment laws, et cetera. So you're going to end up forming an entity in the U.S. There's several types of entities that are available in the U.S., but there's really two that in your situation coming into the U.S. are most practical: corporations and limited liability companies. Many of you are probably familiar with corporations and how they work. So we thought we'd go through a chart comparing corporations to limited liability companies, which fewer people are familiar with, to try to show you the differences and get you more familiar with limited liability companies. So if we go to the next slide there. So for both a corporation and limited liability company, you're going to form at the state level. You're going to file a form at the state level to get it formed. So for example, you're going to form a New York corporation or a New York limited liability company. It's going to be formed in a particular state. Corporations have shareholders. Their owners are shareholders. For limited liability companies, their owners are members. Management, you're probably familiar, corporations have boards of directors. That's who manages the corporation. For limited liability companies, there's great flexibility. You can manage them however you want. You could have a board of managers. They could be managed by the owners, who are called members, or you could contract out for a third party to manage them. It's up to you. There's a great flexibility in how you manage a limited liability company. For both corporations and limited liability companies, one of their key attributes is they protect you from liability. So they are respected under U.S. law as a separate entity. So generally, a corporation is responsible for its own obligations and liabilities, and the shareholders, the owners behind that corporation, will not be liable for its liabilities. And the same goes for a limited liability company. The members will not be liable for the obligations of the LLC. Next slide, please. Fiduciary duties. So both for directors and officers of corporations owe fiduciary duties to the corporation and the shareholders. And the same goes for limited liability companies. The managers and the officers of limited liability company owe fiduciary duties to the owners and to the limited liability company. However, again, for limited liability companies, there's a lot of flexibility. It's much easier to limit those liabilities, to restrict the fiduciary obligations that officers and managers have, that you can do in a limited liability company that you really cannot do to the same degree in a corporation. Employee incentives. There's stock options. I'm sure you've heard of those. There's different types of stock options. Some are more tax advantageous than others. For limited liability companies, it's difficult to do stock options, but they have something else called a profits interest, which is very tax favorable for your employees. The only downside there is that U.S. employees are not as familiar with profits interest or LLCs. so it can be a little more difficult to explain to them what they're getting. The next category we're comparing is distributions. In a corporation, it's relatively rigid. You have to make distributions in proportion to stock ownership. If you own 5% of the shares, you're going to get 5% of the dividends for that class of shares. Full stop, no flexibility. For a limited liability company, however, it's very flexible. Whatever the owners agree among themselves can be the distributions. One owner can get all the distributions for a period of time and then switch 50-50. One owner can get all the losses. They can divvy up the losses and profits however they want. It's completely up to the owners and how they want to allocate distributions. And then in the bottom, the other, I think the main point here is that they both of these provide a lot of protection from a liability perspective for the owner. However, given all the flexibility in a limited liability company, as a startup proposition, there may be additional decisions to be made, and it can be a little more complicated starting up, but nothing that is too complicated to handle. Okay, on to the next slide, please. So you're going to form an entity in the U.S. Where are you going to form it? You can form it in any of the 50 states. How do you choose? Well, as I'm sure a lot of you've heard, most entities are formed in Delaware, one of the 50 states. There's probably a more than 50% chance that your entity, if you came to the U.S., is going to be formed in Delaware. Why is that? There's several reasons. One is that Delaware has very owner-friendly laws, so they're favorable to shareholders and members. They also have very favorable laws for directors and officers and managers and members. So your people you retain in the U.S. who are going to be directors and officers are going to be very comfortable with Delaware law applying. Remember, the particular state that law is going to apply to your entity. Delaware has very sophisticated laws that reflect the latest developments in corporate and LLC law. So another reason why people pick Delaware. The courts and judges are very capable and experienced with business disputes. So the thinking among U.S. lawyers is that if you have a complicated commercial dispute, if you have it in a Delaware forum, a Delaware court, it's going to be more apt to be handled in a sophisticated manner and properly. Your advisors are going to be familiar with Delaware law. So you may set up operations in Texas, let's say, but you could still have your Delaware corporation, and your attorneys and your accountants based in Texas will be very comfortable with Delaware law. They'll be familiar with Delaware law, even though they practice in Texas and they're very familiar with Texas law. They will also be familiar with Delaware law because all corporate transaction attorneys across the country are very familiar with Delaware law. And then finally, your investors and lenders are going to be comfortable with Delaware law. They're going to be familiar with it. A lot of the people they work with, a lot of people they invest with, a lot of people they lend to are based in Delaware. The last point I'll make here is that no matter what state you form in, if you decide to form a New York corporation, a Delaware corporation, a California corporation, it will not affect your ability to do business anywhere in the U.S. You can do business in any of the 50 states, no matter where you formed your entity. That's not an issue.
And Bill, I'll just chime in. A lot of people will ask me that they'll think there's some great tax benefit to Delaware. There's not. I wouldn't say a tax benefit, but Delaware is a tax neutral state. So if you form in Delaware and you operate in other states, Delaware will not try to tax you if you're not doing business operations in the state, whereas some states will.
Okay, so next we're going to talk about just the basic steps for forming your entity. It's pretty simple and straightforward. You got to decide who the owners are going to be. You got to identify individuals going to serve on your board of directors or your board of managers. There's not as much use of powers of attorney in the U.S. as there are in some other jurisdictions, so you really have to have individuals who are going to make these decisions as a board. You will have resolutions adopting the formation documents of your entity. You have to decide, if you're forming a Delaware corporation, you have to decide where your operations are going to be. Are you going to open an office? You're going to have employees in Texas. You're going to have employees in California. Wherever you do business, you're going to have to qualify to do business. You're going to make a filing in that state, let's say Texas, to let them know that this Delaware corporation is going to be doing business there. Here's our mailing address. So if you want to tax us, if you want to send us notices, here we are. At the formation stage, there's also decisions that may be made about indemnification. So in the U.S., in the formation documents, you can provide that the entity will automatically indemnify officers and directors to the full extent permitted. So that means that in the formation documents, you're taking away some of the discretion from the board of directors or the board of managers, and you're saying to your officers and directors, look, if you serve this role for us and you get sued because you were an officer director for our entity, the company will stand behind you. They'll cover your legal costs. They'll cover any other costs necessary to defend you in that dispute. So you can decide up front when you form your entity that we're going to put in the formation documents that we are going to do that to the full extent permitted. Or you could not address it in your formation documents, and then it becomes a board decision when the dispute arises. So if you leave it blank in your formation documents, if one of your officers or directors is sued, they will then have to go to the board and say, look, I just got sued. I think the company should back me up and pay my costs. This is what happened. And then the board will make a decision based on the merits of that case, whether or not for that particular situation, they want to indemnify the officer or director. So that's a conversation you'll have with your advisor when you form the entity. That's just a preview. Most U.S. corporations provide for indemnification automatically because their officers and directors want it. But in a middle market and smaller businesses, you don't have to do this, and it's a conversation to have with your advisors. Another thing to think about is the name of your entity. When you form your entity, let's say you form your entity in Delaware, you will have to make sure that the name's available in Delaware. No other corporation or limited liability company has an identical name to the name you want to use. However, that will not provide any protection for that name should you want to market that name, make that name into a brand. So if you think that name's important for your business, in addition to forming the entity under that name in a particular state, you will do searches at the federal level, and you will get advice to get a trademark. You will probably want to trademark that name in the US, so you'll have a national right to that name. No one else with a very similar business that could be confused with your business can use that name once you have a trademark, and you can protect that name in the US. The last point I want to make, and then Vinay has a couple points on the slide, is that forming entities in the US takes days, not weeks. It's relatively quick compared to some other jurisdictions. It's relatively easy, so it's not something that you have to worry about taking too much time. Once you decide you want to come to the U.S., you want to open up for business, we can get this done in a matter of days. And I think Vinay, you want to talk about.
So picking up on the number of days. So in the U.S., once you go through the legal steps that Bill just mentioned, you form your entity in Delaware. The next thing you need is a number that's issued by the U.S. Internal Revenue Service, IRS, known as an Employer Identification Number, or EIN. And even if you don't have employees, you don't worry about that fact. The EIN is a very common term in the US, and that's a number you need to do just about anything. Certainly to open a bank account, enter into contracts, third parties will want your EIN. So forming a company in days is not very helpful if it takes weeks to get the EIN. So to get the EIN, if you are a domestic company with domestic officers, the EIN can be obtained online, no issues. There is a little bit of a twist that when the entity applies for an EIN, they ask for a person, or what they call a responsible person, to be associated with the account. And if that responsible person does not have a US Social Security number, you can still get the EIN, but now the process has gone from being online to potentially 3 to 4 weeks. So just keep that in mind as you're coming into the US and you're starting operations, that you could hit a delay if you do not have a person who's in a senior position who does not have a US Social Security number. So that's the EIN. The next challenge that we see companies having is opening a bank account. And they have a challenge in my and Bill's experience. Oftentimes companies will come to the US and they will start very small. They may not send anybody. They may just set up an entity to do some contracts, service contracts, or they may just send 1 or 2 people working out of their house. Banks all over the world are subject to these requirements called KYC, or Know Your Customer. And in our experience, if bankers cannot walk into an office and meet people and see people. They sometimes are reluctant to open accounts. So not to say that that is a obstacle, because there are some banks that are more open-minded to that. But I just throw that out there as another potential delay in getting your business up and running, is opening the bank account if you do not have a commercial presence. And usually, whoever the advisor that you're using to steer you through the process, your accountant, your attorney, probably, I would go to that person and ask for personal recommendations, because that can make a big difference instead of just walking into a branch trying to open an account. So now let's go to Bill. We'll talk about employees.
Okay, so we've set up your entity and it's time to hire some employees. So almost all employees in the US are employees at will. That means that an employee at will means the employee can be terminated for any or no reason. There is a short list of unlawful reasons you cannot terminate an employee. That list being, you cannot terminate someone due to their race, their gender, their ethnic background, their religion, or a disability. But other than that, if they're an at-will employee, you are free to terminate them for no reason. And that's a big difference in the US compared to other jurisdictions. And the philosophy behind that, I think, is that if it's easier to terminate employees, then employers are more apt to hire them. They're just not committed. It's not locked into this cost. And so it's easy hire, easy fire. And related to this, it's unusual that employees in the US have employment contracts. Very senior executives do, but in general, most people are hired maybe with a letter, maybe orally. It is not customary that you have to draft a contract for each employee. However, there are certain situations where you might want to have a contract employee. The reason senior executives have contracts is because they want to have more protection than employment at will. They often are negotiating for protections and notices to make it harder to terminate them. But for average employees, that's unusual. But for your employees, you still might want to have some contract in place. For example, if those employees are inventing, if they're creating code for you, they're making inventions, you may need documentation in place to make it clear that any and all inventions are going to be assigned to your company. For senior executives, you are able to enter into non-competition agreements for a certain period of time. After they stop working for you, if they've entered into one of these agreements, they cannot work for a competitor. And those are, as you can imagine, very sensitive contracts. The law changes very much between different states for those contracts. So that's something you should definitely consult with your attorney before drafting or entering into. And the last type of contract you may think about entering into with your employees is what we call a non-solicitation agreement. That's an agreement restricting your former employee's ability to seek business from your customers, to try to hire away your employees after they're no longer employing from you. It restricts their ability to do that. The next point I wanted to make about hiring employees in the US is that unions are the exception. There are unions in the US, but they're not as common as they are in some other jurisdictions. There's a lot of law around unions and what you can do with your employees if they're governed by a union or they're trying to form a union. So if your employees are in a union or thinking about forming a union, you should definitely seek expert outside advice before dealing with that union or before, in that situation. Further down, if you're going to hire somebody who is a non-US citizen, you need to consult with an immigration attorney. There's lots of laws about that in the US, and there's ways to do it, but you have to have some professional advice to get that done. And then the last point here is that there are lots of federal, state, and local regulations around employees in the U.S. and lots of areas where there's litigation between employees and their employer. So it gets very technical. There's notice requirements. There's anti-discrimination regulations. There's withholdings from paychecks, and it can get very complicated and difficult even for people who have been opening business in the U.S. for a long time. It gets very complicated and expensive. So Vinay and I both advise our clients, if you have fewer than 100 employees, it is almost always better to hire a service provider, a payroll service or a professional employer organization to handle this for you and help you comply. They will be less expensive than consulting with your attorney or your accountant to do this. They can ensure that you're going to comply with the law. They can save you back office costs of hiring people to administer your payroll and handle your employees. They often can provide better benefits because they buy in bulk. They have access to better benefits for employees they work with than you might have as a small business. And that can help with recruitment and make you more competitive. So those are reasons why you should consider, with respect to employment, to try to outsource some of those functions in the beginning until you get up to over 100 employees. And I think Vinay, you're going to talk about tax next. Is that right?
Yeah. So just continuing what Bill was talking about, employment, that there are some major federal taxes when it comes to employees, and I just wanted to spend a moment talking about them. So we have at the federal level, we have what we call Social Security tax, and Social Security tax is 6.2% of the first 118,000 of wages. Now there's two layers of this. The employer pays 6.2% of the first 118,000 of wages as an expense to the employer. And also the employee pays 6.2%. It's the mirror image. One 6.2% is the employer's cost that the employer pays, and the other 6.2% is what the employee pays, but the employer withholds it from the employee's paycheck. In addition to the Social Security tax of 6.2%, there is an additional tax known as Medicare, which is 1.45%, which is on all wages, not subject to in excess from $1 with no limit. So for the first 118,500, you'll be paying 7.6%, and then once you go over 118,500, you only pay 1.45%. And just like the Social Security base, the 1.45% is at the employer level, and there's an additional 1.45% that the employer withholds, which is the cost of the employee. So keep that in mind. The states have their own payroll taxes, but they are much smaller. They are generally designed to provide unemployment or disability coverage for employees, but there are some state level payments. But the federal 6.2 and 1.4% are the major payments. All right, Bill.
Okay, so you set up one of the main reasons you set up your U.S. entity was to protect your parent company in your home jurisdiction from the liabilities associated with the U.S. business. So let's go through what you need to do to make sure that works, and make sure that U.S. courts are going to respect the separateness of your U.S. entity and not look through it to the owners. So you're going to make sure that you have a functioning board of directors or board of managers. It's helpful that if the members of that board are not the identical members of the parent board of directors or managers. Same with the officers. You're going to have regular meetings. You're going to document those meetings, keep good records of them. You're going to make sure your U.S. subsidiary has separate assets from its parent. And the most important thing you're going to do is you're going to make sure that your U.S. subsidiary is adequately funded for its particular business. So when courts, when something goes terribly wrong and creditors are not paid in full, or someone's suing the entity, the court's going to look at, well, did they put enough funding in this U.S. subsidiary that they could reasonably anticipate was necessary to do it? Or did they deliberately underfund it and try to leave their creditors unpaid? So you want to adequately fund it for your industry. And part of that is adequately insuring it for your industry. As an example, I have a client that decided to supply U.S. auto manufacturers. It's different than their other businesses in the U.S. They were very concerned about liability in that industry. So we set up a separate U.S. LLC to handle supplying parts. We spent a lot of time making sure the officers and directors of that entity would be separate, that it'd be adequately funded, that it had adequate insurance for that particular line of business. Another thing to think about is you want third parties to know that your U.S. subsidiary is a separate entity. So your website, your stationery, your customers, your vendors should know they're dealing with the U.S. subsidiary, not with the home country parent entity. The whole purpose of this is to get your profits out of the U.S. entity, I'm sure. You can do that, but the more predictable you can make that, the more regular you can make that, the better it looks like if someone is accused, if the worst case scenario happens, which is you can't pay your bills and a court is looking at your U.S. subsidiary saying, well, why can't everyone get paid? Where did all the money go? If you made predictable distributions on a regular basis and they were reasonable, then it's much easier to defend. In addition, any intercompany relationships you want to document. So if you have other affiliates in the U.S. or you have foreign affiliates, you want to document those relationships to show it's a separate entity. We talked about indemnification of officers and directors. I have had many clients who are global clients, have their insurance advisors outside the U.S., get and rely on them for their U.S. insurance needs, and then it turns out they're underinsured for the U.S. I think it's very advisable that you find insurance advisors who have expertise in the U.S. and for your particular industry. And if you don't have those, your attorney or your accountant can introduce you to some. They're very capable people who can do that. You want to make sure you're adequately insured. And finally, I just want to mention the Foreign Corrupt Practices Act. This is an act in the U.S. That prohibits offering bribes to government officials anywhere in the world. And it's a criminal statute. The U.S. authorities take it very seriously. Your U.S. subsidiary will be subject to this. So just something to be mindful of if you're going to start doing business in the U.S.
Okay, so now let's think back to what Bill said a few minutes ago about the types of entities. And the primary entity that most foreign businesses entering the U.S. use is what we call as a C corporation. Now, Bill spent a lot of time talking about LLCs versus C corporations, and there's a distinction legally, and that's what topic of Bill's conversation was. But even an LLC can make an election to be taxed as a C corporation. So regardless of what side of the LLC versus C corp decision you came out on, chances are you're going to want to be taxed as a C corporation. So a C corporation is a separate taxable entity in the U.S. The corporation calculates its income based on U.S. tax principles and pays a tax of 21%. This is at the federal level. We're going to talk about the states in a minute. So we pay a corporate tax rate of 21% on the net income. As long as the income is reinvested within the corporation, there's no additional tax. Now, what will happen when we want to pay a dividend from the U.S. corporation to the foreign shareholder? So in the U.S., we have our rate of withholding statutorily is 30%. Now, in many of the countries the U.S. has tax treaties with, and those tax treaties can either reduce the 30% to a smaller number or eliminate it. That may be something to keep in mind, that we can have a lower than 30% tax, but if you're coming from a non-treaty country, you have to assume 30% of U.S. tax will be withheld, and then the burden will become, can you get some sort of tax credit for that in your home country? Bill also spoke about making sure that the U.S. subsidiaries is adequately capitalized. So one of the questions always becomes, well, can I capitalize it with equity or can I capitalize it with debt? Because generally you like debt because you can take the debt, you can repay the debt without paying any dividend tax. So what the U.S. says is that if I pay interest to a foreign party and they own less than 10%, there is no U.S. tax withholding. But if they own more than 10%, then on the interest, there's going to be a 30% rate of withholding. And again, that can be reduced if I'm coming from a treaty-based country. And before we get to that, the question becomes, okay, how much of the money I'm putting in should be debt versus equity? Well, the U.S. doesn't have any objective rules about minimum capitalization. It's basically a facts and circumstances test. And we try to look to see, okay, would a bank loan you money on these terms? A bank would never lend 100% of the startup capital to a new business, right? Maybe they would lend 30, 40, maybe 50%. So we try to use those kind of commercial standards for tax purposes. And also for the ability to deduct interest expense. There's generally a limitation of, 30% of your earnings before taxes. So you cannot exceed that 30% threshold to be able to deduct the interest expense. If you do, that interest expense is suspended and it just gets carried forward and it gets deducted in the subsequent year. So sometimes, I'll get approached by clients and they'll say, look, Vinay, I really don't want to form a U.S. entity. I don't know if I'm going to be doing a lot of work in the U.S. I want to try it. Why can't I just operate as a branch in the U.S. From my entity in my home country? And in the U.S., we don't like that because when we don't have a separate entity, there's this grayness or lack of clarity as to where the U.S. business stops and the foreign business begins. And the U.S. looks at one of two terms known as effectively connected income or permanent establishment to determine what is the base of operations in the U.S. And again, that can be subjective. There is a tax scheme that applies just for these types of branches known as branch profits tax and branch interest tax. They're very complicated and there is some subjectivity associated with them, so we generally don't recommend them. And for a very similar reason, we don't really recommend people using partnerships in the US. And the primary reason is, well, let me take a step back. In the US, a partnership is not taxed, the partners are. I know in other countries, sometimes the partnership is taxed and the partners are not. But in the US, the partnership doesn't pay any tax, but the partners do. So what happens if I have a US partnership that has a foreign partner? Well, then the partnership must withhold 30% or a lower treaty rate on the income that's allocable to the foreign partner. And why this can be a challenge is that the withholding is based on the income, not necessarily the cash. So if a partnership is profitable, but it's using all its money to reinvest into the US operations and not making any distributions to the partner, then somebody has to come up with that cash to fund that withholding. So again, partnerships are not typically high on our list of choice of entity to use when entering the US. So up to now, I've only been speaking about federal taxes. So as Bill said early on, we have 50 different states in the US. And unfortunately, they all have their own tax system. Now, most of them are very similar. They will, for a C corporation, they will start with the federal income and they will make some modifications and they will apply a state tax rate, which is generally anywhere between 5 to 12%, depending on the state. But I guess there's two questions that come up before you get to the actual calculation. The first question is, how do you figure out what states you have to file in? So that is a concept called nexus, where the state says, if you have nexus, that means you have the minimum connections to our state to allow us to tax you. And nexus generally comes from one of two ways: a physical connection to a state, meaning you have an office, an employee, you have inventory in an Amazon warehouse, you have some physical connection to that state, and in those cases, you're going to have nexus. Other states have a concept called economic nexus, meaning that you may not have no physical connection to the state, but if you do a certain quantum of business in that state, then that state has the right to tax you. So California has a number, I think it's around $400,000 of sales, that if you're doing $400,000 of sales to California customers, California says they have the right to tax you and they will impose nexus. So you have to be mindful of all the 50 states rules. And so now you've got your list of states that you have nexus in. Where do I have to file? So now the question is, how do I figure out? Most people think that, okay, if I have to file in California, I pay tax to California on my California sales. It doesn't work like that exactly. Basically what happens is we look at the federal income, think of it as a pie, and each state says I'm entitled to a certain portion of that pie. And most states will say the portion of your federal income that's allocable to my state is a fraction. The numerator is the sales in our state, and the denominator is the total sales everywhere. So if 4% of my sales are in California, then I'm going to offer to the California Franchise Tax Board 4% of my federal income to be subject to the California corporate rate, which is about 9%. So conceptually, I'm oversimplifying, but conceptually, that's how the state tax mechanism in the US works. The biggest trap is nexus, meaning that you just have to be aware of that, meaning that you could be subject to tax in states that you don't think that you're operating in. So what I just mentioned was income tax, the direct tax. In the US, our primary indirect tax is sales and use tax. Most other parts of the world will have either a VAT or a GST type tax that has inputs and outputs. In the US, it's a different concept. In the US, we look at, there's no indirect tax until you get to the final sale to the end customer. And when you have that final sale, the vendor making that final sale is responsible for collecting the sales tax from the customer, adding it to the purchase price, and remitting that to the state taxing authority. So that's the concept behind sales tax. Every state has their own rules, and some states will differ about what they tax and what they don't tax. Most states tax primarily, most states will consider subject to sales tax tangible personal property or goods, and generally not services, but that's an overgeneralization. So you have to look to see what are you selling. Many states don't tax medication, some states don't tax food, so you have to understand what is being subject to sales tax. Like I mentioned before with the income tax, economic nexus, there was recently a Supreme Court case, you'll hear it called Wayfair, that basically says that if you have $100,000 of sales in a particular state, that state has the right to tax you. And sales tax is especially important because if it's done right, sales tax is an economic obligation of the customer. But if it's not collected, the state will put the burden on the seller to send the state the sales tax. So, and that may not happen until 2 or 3, 4 years later, at which point you cannot go back to the end customer. And now a meaningful, number, call it 5% of your gross sales, is now an obligation of the company, which can be very disruptive and even very destructive. So sales tax is something very important to focus on. If you're in the business of selling goods online, there are a number of online software platforms that will integrate with your shopping cart, integrate with Amazon, what have you, to make sure that you do this right from the beginning. But that's something that's quite important. We are at 11:45, Bill, so I'm going to go through the rest of this kind of quickly. Treatment of executives coming to the U.S. If you're sending somebody to the U.S., the key thing here is that we have non-residents and residents. If you are a non-resident, you're only taxed on worldwide income. I mean, you're only taxed on U.S. sourced income. If you are a resident, you're taxed on your worldwide income. And the myth is that the only way to be a U.S. tax resident is if you're a citizen. That is not correct. You are taxed as a U.S. tax resident if you're a citizen. If you are a U.S. permanent resident, often known as a green card, or if you spend a significant time in the U.S. And I'm not going to go through this in detail, but there's a test known as the substantial presence test, which is a rolling average of your number of days. And if you exceed this threshold, you could be here on a temporary visa and become a U.S. tax resident without even knowing it. So that is something to pay attention to. If you are coming to the U.S. On a green card or any sort of long-term assignment, I would seek out professional advisors before you come to the U.S. because there are some steps that can be done prior to coming to the U.S. To minimize your personal tax liability before you become subject to U.S. worldwide taxation. So now you formed a business, it's been successful, now it's time to sell the business. What are some things to think about? So from a tax point of view, if you've set up your business as a C corporation, generally speaking, if you're selling, you will want to sell your C corporation shares, because if I am a individual living in Brazil and I sell shares of a U.S. corporation, and again, there is no U.S. tax because the taxation is referenced by the residence of the seller. If the corporation sells its assets, now I have a double tax. The corporation will pay that 21% tax on the sale of its assets, and then I'll have to send out that money as a dividend. Well, when I send that money out, it is probably subject to dividend withholding tax. So as a seller, I generally always want to buy shares. I generally always want to sell shares. Buyers have the opposite motivation. They want to buy assets. They don't want to step into any liability that the prior seller had. Plus, if they buy assets, they will get a tax benefit that they will not get if they buy shares. So before you even begin to talk to people about selling, this is an important distinction to get clear early on in the discussions, because once you start going down the path of an asset sale or a stock sale, it can be very difficult later on in the process to change gears once you realize there's a significant tax cost. I'm going to skip FERPTA. Bill, do you want to comment on some of the things to think about when you're selling your business?
I think maybe we just skip this and go to the last,
Sure.
when to consult your attorney or accountant.
Sure. So Bill, why don't you take this one?
Sure. Just we're going to leave some time for questions. So just these are things to think about after you've already set up your operation. You've been operating in the U.S. When else is it important for you to think about consulting some of your advisors? Obviously, if you're threatened with a lawsuit, you get a letter threatening a lawsuit, or another threat of a lawsuit, I think you should consult with an attorney. If you're entering into a real estate lease, these are usually very complicated negotiated documents in the U.S. So if you have a commercial lease, you should consider check with your advisors. If you're buying or selling a business in the U.S., that is usually very legally technical and a lot of tax implications, so you should check with your advisors. If you're selling equity, that is a regulated exercise in the U.S., you should check with your advisors. If you're granting equity to employees, you should definitely consult with your advisors. Obtaining a bank loan, most bank loan documents are negotiated in the U.S. among attorneys. As I said before, entering a contract with a union, terminating an employee. This is an area where there's, as I said before, there's lots of disputes. If you haven't done it before, you should definitely consult with your advisor before terminating an employee, creating a record of what's happening, entering into a significant contract, terminating a contract early. If you're not going to adhere to the terms of a contract, or you think the other side is breached, you need to terminate it. There's often disputes in that area, so you should get some advice before you terminate the contract. And then finally, when you wind down your operations, or you dissolve the entity, particularly if all the creditors are not going to be paid in full, you should definitely seek the advice of some advisors to make sure you do that properly and with minimal liabilities. So that was it on that slide.
Okay. I think that was the end of the prepared, what we planned for. I think we're happy to take in any questions.
Questions that have come in, 4 in total so far. So we'll just go through them rather quickly. So the first one is, we are considering doing a joint venture from Mexico with a U.S. company. How should the joint venture be structured?
I think, Vinay, you should take the lead, because in the U.S., most structures are really driven by tax issues for joint venture.
Sure. So as I mentioned before, when people say the term joint venture, it typically means some sort of partnership format in the U.S., where two parties are coming together, they're forming a special purpose vehicle. Often it might be an LLC, and we're going to treat it as a partnership, meaning the entity won't pay tax, the partners will. The other partner is probably a U.S.-based company. They can do their own thing, however they want to do it. But as a foreign entity, the Mexican entity who's coming into the U.S., for all the reasons why I said partnerships are not great ways to operate in the U.S., what we typically will do is do something called a blocker, meaning the Mexican entity will form a wholly owned C corporation in the U.S., and that C corporation will be the partner in the partnership. So as far as the partnership is concerned, it's a domestic partnership with two domestic partners, the unrelated party and the U.S. Blocker Corp. And then the U.S. Blocker Corp can retain the funds in the U.S. for future business or make a dividend payment to the Mexican parent. So in a nutshell, that's kind of how we would approach the situation.
Okay,
great. I would just add to that for all the reasons we talked about how flexible limited liability companies are, that's why they're used in joint ventures. So you and your partner can decide how to divvy up distributions, management, however you want, because you're not constrained by a corporate structure. You can kind of, whatever the two parties agree, can be how that's managed, how distributions are made, losses are allocated, et cetera.
Okay, great. The second question is, if I start a company in the US, what type of financial and ownership information is required to be publicly disclosed?
Vinay, want me to start that?
Yeah, why don't you start on the ownership
The
side?
short answer is very little compared to other jurisdictions. When you form a corporation, you have to come up with a name. You have to have a registered agent in that state, but you can retain someone to do that. Someone has to sign the certificate that forms the entity. That could be your attorney. So you can form it basically without disclosing who the owners are. And then for a corporation in Delaware, there's annual reports. Every year you'll have to do a report to the state. You'll disclose your tax ID number, your main business address, officer name, and address of directors, and the name and address of a director. But again, you never disclose who your owners are, which is unusual for a lot of jurisdictions. And then Vinay, you want to talk about financial?
Well, I was just going to say that, one of the clients that come to are often shocked because in the US, we don't have any concept of required audited financials. We don't have something equivalent to Companies House as they have in the UK. Really, as a business, you're responsible for keeping your books and being able to support your tax filings. And the IRS, as a tax agency, can come and audit you and look into things. But other than that, there's no requirement for a third-party audit or any other attestation to your books. So whether you do it or not whether you get an audit or something else is completely based on your business needs.
But that audit need is from a legal and from a tax standpoint. However, if somebody wants to take a bank loan, the bank most likely is
the
going
bank
to
very well may require an audit. Yes. Yes.
Right?
Yes.
Okay. So the third question is, are there exceptions to the corporation or LLC in terms of limited liability, such as things like willful misconduct or gross negligence? Or do those things just apply for like directors and officers' insurance concerns?
Well, that's a complicated question in some ways. But in general, courts in the US want to honor the separateness of the corporation or the LLC. I mean, the business world in the US is based on that. So usually, their courts are very reluctant to ignore that structure and try to make the owners liable. So usually, not only is someone not paid in full, not only do they not follow those guidelines we talked about, but there's some sort of fraud. Someone did something really pretty egregious, because it's pretty unusual for a court to say, well, we're going to ignore this corporate structure and we're going to make the shareholder or the members liable. Not that, so I don't want to encourage anyone to think that you can just ignore all those guidelines, but in almost every case where an owner has been found liable for a liability of a corporation, it's been because the court suspected some pretty egregious behavior. The classic example in the US is someone had a taxi company and realized that, 5% of their taxis get in an accident every year. So they put each taxi in a different corporation. And every time a taxi got in an accident, they said, well, that was the taxi was the only asset in that corporation. So good luck. You can get the wrecked car. And the judge said, you knew going into this business, 5% of them will get in accidents. You need to have adequate insurance or adequate capital. So when that accident happens, there's a reasonable chance that the person hurt in the accident could be paid. So it's kind of a judge is going to look at this and scrutinize it. But as long as you act reasonably and get adequate insurance, you should be protected.
Okay, so we got about 3.5 minutes and two more questions. The first one here is there a range of revenue or any other financial requirements that are mandatory for an entity in their home country before they can expand to the US?
The short answer is no. There's no requirement of anything like that.
Great. And then the last question we have here, are there any of the states in the US that don't follow an employment at will? Does anyone have laws that are different? Because you had made a statement that generally there's employment at will and you can fire people except for those, discriminatory things. But are there some states that don't follow that employment at will?
Yes. I mean, there are certain states that are much more employee protective, California being the leading one. New Jersey and New York being much more employee protective. They still have, there's more subtlety, but they still have employment at will, but it's less at will than for other states. So, but in general, California is very, very protective, and New York and New Jersey are pretty protective, and most other states are pretty not protective. It's pretty pro.
Okay. All right.
Very simplification, but in general.
Yes. So that's it for the questions. Is there anything that either of you thought of along the way that you didn't think of when you were preparing this that you think, oh, I should have included this? Is there anything else that you'd like to share?
Not really. I think just plan in advance before you come to the U.S. Find the right advisors and do your planning first.
Okay. And if people have further questions, such that they're actually looking to do something in this regard, I'm assuming they can reach out to either one of you.
Of course.
And your contact information, we'll put that up on the slide here before we go, just one last time. And with that, I'd like to thank Vinay and Bill. Excellent information. I don't know where some of our members in our other countries, other than the U.S., could get this information so much in such a little time. So I want to thank you guys very, very much.
Well, thank you for having me. My pleasure.
Okay, great. Thanks a lot. Bye-bye, guys.